Imagine walking into a grocery store where the person in front of you pays $3 for a gallon of milk.
Right.
But then you step up to the register, the cashier scans that exact same jug of milk, and they charge you $10.
Which would be front page news if that actually happened.
Exactly. I mean, in the retail world, that is completely illegal. But in the insurance world, that's just a regular Tuesday.
Yeah, it really is.
The entire transactional logic that we rely on for literally every other purchase in our lives gets completely thrown out the window when we talk about buying an insurance policy. I mean, we all pay this bill, usually begrudgingly, but very few of us actually understand the invisible mechanics operating behind the scenes once that money leaves our bank accounts.
And it feels opaque by design to a lot of people. You are handing over a significant amount of your income for something you desperately hope you never actually have to use.
Right.
The value just isn't tangible in the way a new pair of shoes or like a fresh pizza is tangible.
Which is exactly why we are taking this on today. So whether you're a dedicated CPCU student cramming for your next credentialing exam, or maybe a seasoned insurance professional looking to sharpen your technical understanding, or even just someone trying to crack the code of how this industry actually functions, welcome.
Glad you're here with us.
Today's mission for this deep dive is to unpack one of the most fundamental concepts in the entire financial universe, and that is the premium. We are going to deconstruct how this single concept dictates the survival, the profitability, and the competitive edge of the entire global insurance industry.
Because it is the absolute lifeblood of the system.
Yeah.
I mean, without the premium, the entire concept of a commercial insurance market just instantly collapses.
It doesn't exist.
Exactly. So to really understand the industry, you have to understand the math, the psychology, and the regulations governing this specific transaction.
Let's start with the foundational definition, because everything else we talk about builds on this. So a premium is simply the amount of money an insured pays to an insurance company in exchange for coverage during a specified policy period. It's the price of insurance. And there is a very structured cadence to it, right? You might pay it monthly, quarterly, semi-annually, annually, or even as a single lump sum, just depending on the contract you sign.
Yeah, and there is a really helpful mnemonic device often used in introductory courses. It's the rule of P.
Oh, right, the rule of P.
Yeah, so premium is what you pay. It is the price of protection. It sounds incredibly basic, I know, but establishing that definition is critical before we get into the heavy mathematics of how that price is actually formulated.
Okay, let's unpack this a bit because I have to push back on something here. A common way this is explained is by comparing an insurance premium to, like, a Netflix subscription or a gym membership.
Sure, yeah.
You pay a recurring fee for a service. But I genuinely struggle with that analogy. With a streaming service, I am watching movies every month. I am actively consuming the product.
Right.
And even with a gym, I mean, the treadmills are sitting there, the lights are on, the facility is available. But if I pay a car insurance premium for 12 straight months, and I am a perfectly safe driver who doesn't get into a single fender bender, I haven't consumed anything. I didn't get a service. It feels like I threw hundreds of dollars into a black hole.
Well, and that is the ultimate psychological hurdle for the consumer.
Yeah.
It totally feels like a sunk cost with zero return. But that frustration stems from a fundamental misunderstanding of the product itself.
How so?
Well, when you pay that premium, you aren't prepaying for a claim. You aren't buying a physical payout. What you are purchasing, literally the millisecond that policy goes active, is the transfer of risk.
Okay. So the product isn't the money they might give me after a crash. The product is the transfer itself.
Precisely. And this is the golden rule, particularly for anyone taking a CPCU exam right now. Premium is the price paid for transferring risk. Think about the sheer magnitude of the financial liability you carry every time you pull out of your driveway.
Right. It's terrifying if you really think about it.
It really is. One bad intersection, one moment of distraction, and you could be looking at hundreds of thousands of dollars in property damage and medical bills. That is a risk that would bankrupt the average person. So by paying the premium, you take that massive, terrifying financial burden off your own shoulders and place it squarely onto the multi-billion-dollar balance sheet of the insurance company.
Wow. Okay, that reframes it entirely for me. I didn't pay for an accident. I paid for the legal guarantee that if an accident happened, I wouldn't lose my house. I was actively using their broad financial shoulders every single day of that year, whether I crashed or not.
You consume the protection. The insurer made a legally binding promise to bear your risk for that specified period, and holding that risk is a heavy, expensive, capital-intensive burden for them. That is what your premium is actively funding.
So if the product is the transfer of risk, how do they actually calculate the price tag for my specific risk? Because going back to the milk analogy at the start, it's not a flat rate.
No, definitely not.
It changes wildly from person to person, and it's clearly not arbitrary.
Right. So the anatomy of a price is where the science of insurance really shines. It is a two-part system, and it starts with underwriting. Underwriters are the professionals tasked with assessing the specific risk exposure of an individual applicant. They look at the variables that make you, specifically, more or less likely to suffer a loss.
So they're the gatekeepers. They're looking at the fact that, I don't know, I drive a sports car, or that my house is built in a known wildfire zone, or maybe that a business applicant works in commercial roofing rather than just sitting in a quiet office.
Exactly. They are evaluating the exposure. And the core logic is universal greater risk equals a higher premium. The underwriter recognizes the heightened chance of a loss based on your specific profile, and the premium is adjusted to reflect the heavy burden the insurer is about to take on.
But the underwriter isn't pulling a dollar amount out of thin air, right? I mean, they identify the risk, but they aren't building the mathematical pricing model on the back end.
No, no. That heavy lifting falls to the actuaries. If underwriters evaluate the individual, actuaries evaluate the statistical universe.
Right.
Actuaries are the mathematicians who rely on historical data, probability theory, and the law of large numbers to design the baseline rates.
Let's hover on that for a second, the law of large numbers. That is the engine here, isn't it?
Oh, absolutely.
Because as an individual, it is literally impossible to predict if I will get into a car accident next Tuesday. But if you look at 1 million drivers over 10 years, the chaos kind of smooths out into a highly predictable statistical curve.
That is the exact mechanism. Actuaries can't predict individual behavior, but they can predict aggregate behavior with, honestly, terrifying accuracy. They know, down to a fraction of a percent, how many homes in a specific zip code will likely experience a water damage claim next year.
Wow.
And they use that predictable curve to build pricing models that ensure the collected premiums are large enough to support 4 distinct financial pillars.
Okay, these 4 pillars are crucial for anyone trying to understand the business side of the industry. The premium collected can't just be a guess. It must mathematically cover 4 specific buckets. So bucket number 1 is future claims.
Right, and this is the largest and most critical bucket. The premium must cover the expected losses. Actuaries calculate what is called the loss cost.
Okay.
So if they predict that out of every 1,000 homes, 2 will burn down, causing $1 million in total damage, well, they have to divide that $1 million expectation across the premiums of all 1,000 policyholders. The money has to be in the bank before the fire starts.
Which makes sense. Then bucket number 2 is operating expenses, which is obvious when you think about it, but I feel like it's often forgotten by the consumer. Insurance companies aren't charities. They are massive corporate operations.
The premium has to cover the cost of doing business. You have to pay the underwriters, the actuaries, the claims adjusters who actually drive out to inspect the damage. You have to pay for massive server farms to house the data, the office space, marketing, legal teams.
Right.
A portion of every single premium dollar goes toward keeping the lights on.
Okay, bucket number 3 is one I suspect most people outside the industry don't even know exists, and that's reinsurance costs.
Yeah, reinsurance is fascinating. It's essentially insurance for insurance companies.
Right.
Consider a catastrophic event, like a Category 5 hurricane hitting a major coastal city. A single insurance company might suddenly face 50,000 total loss claims in a single afternoon. No matter how good their actuaries are, paying out billions of dollars all at once could instantly bankrupt the insurer.
So they buy their own catastrophic coverage to protect their balance sheet from those extreme world-ending spikes in claims.
Exactly. They offload their most extreme risk to global reinsurance conglomerates. But buying that massive safety net costs money. Therefore, the cost of the insurer's own reinsurance is baked directly into the premium you pay.
And that leaves bucket number 4, which is the profit margin, the cost of capital. I mean, investors and shareholders demand a return on the money they are risking to back these policies.
Right. A reasonable profit is absolutely required for these companies to remain viable, to attract investment, and just stay competitive in the market.
Well, when you lay out those four pillars, so future claims, expenses, reinsurance, and profit, it raises a massive strategic question for me.
What's that?
If I am the CEO of an insurance company and my mandate is to never go bankrupt and always hit those four pillars, why don't I just charge everyone a massively inflated premium? Like if the actuaries say the risk costs $1,000, I'll just charge $5,000. I guarantee my solvency and I make an astronomical profit.
Well, that introduces the fundamental friction of the insurance market, which is governed by a metric called the combined ratio. The combined ratio is the ultimate scorecard for an insurer. It compares the premiums an insurer takes in against the losses and expenses they pay out.
Okay, so if an insurer collects $100 in premium and pays out $105 in claims and expenses, they have a combined ratio of 105%. They are operating at a loss. They are bleeding cash.
Right. And if they run at 105% for too long, they face insolvency. The safety net vanishes entirely. So the mathematical instinct is to set the premium as high as possible to drive that ratio down to, say, 80%.
Right, make a 20% profit.
But if you artificially inflate your premiums just to play it safe, the free market aggressively corrects you.
Because consumers aren't operating in a vacuum. If Company A charges me $5,000, but Company B down the street, whose actuaries are maybe sharper and whose operations are leaner, charges me $2,000 for the exact same coverage, I am obviously taking my business to Company B.
Exactly. The insurer who overprices their product to avoid risk will literally hemorrhage market share until they have no business left. So, the premium has to be just right. It is a razor-thin tightrope walk between remaining competitive enough to attract customers and remaining adequately funded enough to survive a disaster.
Which brings us to the macro view. We know it's a delicate balancing act to cover future costs, but where does the actual cash go when I pay it? It obviously doesn't sit in a little envelope with my name on it, waiting to be handed back to me if my roof leaks.
No, it goes into an aggregate fund. This is the concept of pooling. When you pay your premium, your money is mingled with the premiums of hundreds of thousands of other policyholders.
And this highlights the absolute core philosophical principle of the entire industry. The literature defines it so clearly. Many pay for the losses of a few.
Yes, that is the structural integrity of the entire system. The vast majority of people who pay premiums this year will not have their home destroyed by a tornado, but their premiums fund the massive pool of capital that pays to rebuild the community for the very small fraction of people who do suffer that tragedy. Many pay into the pool so that the few who draw from it are not financially ruined.
But that free market competition you just mentioned earlier, where customers leave if the price is too high, that can't be the only thing keeping these massive financial institutions in check, right? If my money is going into a giant opaque pool, there has to be a referee ensuring the insurers aren't manipulating the math.
Oh, there is. The referee is the state. In the United States, insurance is heavily regulated at the state level by departments of insurance, who rely on model laws developed by the National Association of Insurance Commissioners, or the NAIC.
Okay.
These state regulators audit the actuaries. You cannot just invent a premium rate. You have to literally file your math with the state and prove it is structurally sound.
And state regulators enforce 3 non-negotiable rules for premium pricing. Let's dig into these because they perfectly illustrate the tension between consumer protection and corporate solvency. So rule number 1, premiums must be adequate.
Right. This is the state protecting the long-term survival of the market. The regulators mandate that the premium must be mathematically high enough to actually pay out future claims. The state cannot allow an insurer to recklessly slash prices just to win market share, only to go bankrupt the moment a storm hits, leaving tens of thousands of citizens with worthless contracts. Inadequate pricing is a literal threat to public safety.
Wow. And then rule number 2 balances that out. Premiums must not be excessive.
Yeah, this protects the consumer from gouging. Insurers have to mathematically prove that their prices are justified by actual risk exposures and legitimate operating expenses. They cannot leverage, say, a monopoly in a specific region to artificially inflate their profit margins.
And rule number 3, rates must not be unfairly discriminatory. This one has a lot of nuance to it, doesn't it? Because the whole point of underwriting is to discriminate based on risk.
The key word there is unfairly. 2 people with the exact same risk profile must be charged the exact same rate. You can and honestly must discriminate based on actuarially justified risk.
Right.
Like charging a teenager with 3 speeding tickets more than a 50-year-old with a spotless record is fair discrimination. The statistical probability of a loss is demonstrably different. But you cannot discriminate based on protected classes like race, religion, or national origin, which have absolutely no bearing on the statistical risk of a property loss or an auto accident.
That makes perfect sense. And it is genuinely comforting to know those guardrails exist. But as a consumer or a business owner, am I entirely at the mercy of the state regulators and the corporate actuaries? Or do I have agency here? Like, can I actively manipulate my own premium?
What's fascinating here is that you have tremendous agency through the application of risk management. Remember, the core logic premium directly reflects risk cost. If you change your risk profile, you force the math to change in your favor.
Meaning I can take tangible steps to make a loss less likely or less severe.
Exactly. For a homeowner, installing a centralized fire alarm system that automatically dispatches the fire department, that reduces the severity of a potential fire claim. Installing deadbolts and security cameras reduces the frequency of theft claims.
Right, or for a business.
Yeah, for a commercial trucking fleet, installing telematics that track driver behavior reduces the likelihood of catastrophic collisions.
And when the underwriter sees those interventions, they recalculate the exposure. The risk went down, so the premium must go down. They apply a premium discount.
Yep, it is a direct, contractual financial reward for responsible risk management.
To really cement these high-level regulatory and pricing concepts, let's look at a concrete, real-world scenario. Let's break down the case study of a driver named Sarah from the source material.
I love this example. Sarah's scenario really bridges the gap between the theory and the actual balance sheet.
Right, so Sarah is shopping for personal auto insurance. The underwriters pull her data. She is 30 years old, has a spotless driving record, she maintains excellent credit, and she drives a standard, reliable sedan like a Honda Accord.
From an underwriting perspective, Sarah is highly desirable. She represents a very low, highly predictable exposure to loss.
Okay, so the actuaries run her data through the models, they calculate the 4 pillars, and they set her annual premium at exactly $900. Sarah pays the $900 up front. The policy goes active. Now, 365 days pass. Sarah drives to work, runs errands, takes a road trip. She has 0 accidents, she files 0 claims. The policy period ends. The intuitive consumer mindset asks, what happens to that $900? Does she get a refund since she didn't use it?
She doesn't get a dime back. And this goes directly to our earlier discussion about the true nature of the product. That $900 is now classified on the insurer's balance sheet as earned premium.
Burned premium, meaning the insurer fulfilled their end of the contract.
They did the work. On day one, when Sarah paid that $900, it was actually a liability for the insurance company because they owed her 365 days of protection.
Oh, wow.
Yeah, every day that passed without an accident, they earned a fraction of that money. They aren't keeping the $900 for doing nothing. They're keeping it because they successfully deployed their balance sheet capacity to shield her from ruin for a full year. If she had totaled her car on day 200, the insurer would have been legally obligated to replace it. The year passed, the risk was successfully carried, and the premium is fully earned.
Sarah's scenario makes perfect sense in the real world, but it is exactly the type of scenario exam writers use to lay traps for students. For those of you tuning in who are actively studying for your CPCU designations, understanding the nuances of how that money flows is what separates a passing grade from a failing one.
The premium is completely inescapable in the CPCU curriculum. You cannot earn the designation without mastering it across multiple disciplines.
Right. It is the foundation of CPCU 500, which covers managing evolving risks. It is the core of CPCU 520, insurance operations. You have to understand it deeply in CPCU 530, business law, because the premium is the legal consideration that makes the insurance contract binding in a court of law.
Yeah, it dictates the entirety of CPCU 540, finance and accounting.
Yeah.
I mean, you have to know how unearned premium reserves work and how earned premium hits the income statement, not to mention the specific applications in the personal and commercial risk management courses, 557 and 552.
Because it is literally omnipresent, the exam writers love to test the boundaries between terms that sound identical to the general public but represent wildly different mechanisms to an underwriter. Here's where it gets really interesting. Let's clear up the 2 biggest traps. Trap number 1. Conflating a premium with a claim.
Yeah, this is a test of directional cash flow. Premium is the capital flowing to the insurance company. It is the revenue. A claim is the capital flowing from the insurance company to the insured to indemnify them after a loss. Premium goes in, claims go out.
And trap number 2 trips up consumers constantly. The difference between a premium and a deductible, I mean, both are out-of-pocket costs for the insured, so what is the mechanical difference?
The difference lies in timing, certainty, and risk appetite. The premium is a certain fixed cost you pay to keep the policy active, regardless of what happens. A deductible is a contingent cost. It is a predetermined portion of a covered loss that you, the insured, have agreed to pay out of your own pocket before the insurance company pays a dime. You only pay it if a loss occurs.
To elevate this beyond just consumer out-of-pocket costs, this is really a strategic tool for corporate risk appetite, isn't it? The deductible and the premium operate on a mathematical seesaw.
That is the perfect way to visualize it. If a business decides to retain a higher deductible, so say agreeing to pay the first $50,000 of any property damage claim instead of just the first $5,000, they are actively retaining a massive layer of risk on their own balance sheet. Because they absorbed that first layer of risk, the exposure for the insurance company is significantly reduced. And because the insurer's risk is lower, the premium must drop.
It all circles right back to risk management. Retaining more risk yourself artificially lowers the risk transferred to the insurer, which drops the price tag. The architecture of the math holds up perfectly.
It always comes back to the transfer of risk. Every complex formula and regulatory statute is really just a mechanism to ensure that transfer happens fairly and reliably.
Which brings us to the close of our deep dive. Let's lock in the key takeaways. A premium is the price of protection. It is a highly calculated figure generated by actuaries using the law of large numbers, based on the specific risk exposure assessed by underwriters. That price must mathematically cover expected claims, operating expenses, catastrophic reinsurance, and a profit margin. And it operates under strict state regulations to ensure the entire system remains solvent, fair, and non-discriminatory.
And remember the foundational definition. You aren't paying for a claim, you are paying for the transfer of risk.
To wrap things up, the literature we've covered today highlights a fascinating philosophical reality about this entire industry. When you pay a premium, you are engaging in one of the most counterintuitive transactions in existence. It is the only product you buy where you are actively betting against yourself and desperately hoping you lose the bet.
So true.
You are paying a corporation for the privilege of being wrong about a disaster, but if you are right and the disaster strikes, that premium buys your future self out of total financial ruin.
It is the ultimate hedge against the chaos of life. You are putting a calculated price tag on the unpredictable.
Putting a price tag on the unpredictable, that is a brilliant way to view it. Thank you to everyone for joining us on this deep dive. Whether you are taking this technical breakdown into your CPCU exams this week, applying it to your underwriting desk, or just looking at your own auto policy a little differently, we hope you walk away seeing the mechanics of the industry clearly.
Keep questioning the mechanics and best of luck with your studies.
Until next time.